Good Sunday morning out there to all of the folks listening to us here in Central Florida, along with all the folks around the world that can listen to the program courtesy of the magic of the internet. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. On this week's program, we're going to talk about some of the factors that go into determining the right rate of withdrawal for your retirement savings. Exactly how do you sort of figure that out and calculate it, and what are some of the factors that go into that? We'll talk about that. Plus, we'll share with you some of the disturbing conclusions out of the latest financial survey. It certainly underscores the fact that there is a need for greater financial literacy, financial education among all Americans. So we wanted to share some of the findings of that study and make sure that you understand what the implications are in various circumstances that the study looked into. So all that on this week's program. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So speaking of this past week, markets continue to set new highs, right? Past week in the markets, overall up about 2%. The Dow closed at just above 33,800. S&P 500 at just over 4,100, 4,128 was the close on Friday. Up about 10% so far in the year 2021. And that's kind of fascinating considering that you had a change of administration, you had an ongoing pandemic, you've got supply chain problems, you've got demand. I mean, it's kind of an interesting kind of sort of almost a tale of two cities, right? So you've got the story that demand is literally going to become unleashed, if you will, during the course of the next few months, and understandably so, as more and more Americans get the vaccine. There's some economic forecasts that predict that this quarter that we're in now, the second quarter that runs from April 1 to June 30th, that this quarter you might very well see economic growth on the order of 8%. That is a number that is huge in any circumstances, but certainly a big number. It's expected that, for example, the economy for the entire year expected to grow at about 6.5%. If you consider sort of our longer term trend over the past 10, 15 years, that usually has been hovering in the 2 to 3% range. So you can kind of see where that is the pent-up demand story, where you have all the folks that have been sort of staying at home and not able to go out and do things. And when, of course, you do things, you spend money. And because that hasn't been happening, then it's now widely expected that that will be happening more as the vaccine rollout continues. Then you would expect to see corresponding economic growth. So that's sort of the one force at work currently as we look ahead over the next few weeks and months. Against that backdrop, though, you've also got some signs of some issues, right? You've got the low supply of cars. I don't know if you saw those stories over the course of the past couple of weeks, but new car lots are basically empty. They can't get cars. Why can't they get cars? Because they can't get the chips, the semiconductor chips that go in the car. So there's some supply chain issues. If you've tried to order a window lately, you know that you've got a several month waiting time on that. If you've been to your local hardware store and tried to buy a stick of wood, you know that there's also a little bit of a price increase as it relates to wood. Supply chain also affecting what's going on at the mall. If there's anybody that still goes to the mall, I guess, in today's world, the reality is that the supply of clothing is down. The current, New Year's fashions, those kinds of things have not been able to get into the stores at the level that you would typically expect. So that, combined with these disruptions in the supply chain and now this higher demand, could very well create some level of inflation, right? I mean, just remember your simple economics 101, right? If I have a supply issue and my supply is down, but then correspondingly my demand is up, that's going to cause prices to increase. So, and then if you do wind up with some level of inflation, then the pressure is going to be on the Federal Reserve to raise rates. When the Federal Reserve starts to raise rates, the old adage of don't fight the Fed goes out the window, because the reality is that higher rates have a tendency to curb economic growth, and that could very well reduce economic growth and ultimately cause some problems in the stock market as well. So against that backdrop, that's why our main communications to our clients so far this year have been really about engaging in this conversation about rebalancing, and not just rebalancing, because what happens is, if the stock market has been doing this well for a 2 or 3 year period of time, and the reality is it certainly has been, then you may find that your investment allocation, let's say you started out at like 70-30, 70% stocks, 30% bonds, you may find very well, wait a minute, the ratio now is 75% stocks, 25% bonds, because of the strength of how the stock side of the equation has been performing. And so it's important to kind of go back and sort of rebalance that. In other words, sort of trim the profit, if you will, because the reality is when you sort of look at the numbers, and understand that this isn't a commentary about what may or may not happen in the future. We know that markets are always volatile, whether it's 2021 or 1991 or whatever, or 2041, the markets will always have some level of volatility. So this isn't really, the notion of rebalancing or trimming profit isn't really a commentary about what may or may not happen in the future. It's really more of a commentary of, okay, here's what has happened to your portfolio over the course of the past 3 years, over the course of the past 5 years, and it really has gotten out of balance, particularly when if you've got a diversified portfolio of a variety of different mutual funds like our clients at the office have. You're going to notice that there are some funds that have done quite a bit better than others, and the reality is, of course, those are the funds that occupy that large growth space. So think the names Facebook, Amazon, Netflix, Google, that kind of thing. And so if you look at that, not only is your performance over the course of the past 5 years somewhere in the 14, 15, 16% range, in those particular funds, you may find that you are at least 20% or better over the course of the past 5 years. Well, I mean, just do the math, right? I mean, if you're expecting in retirement and your planning, if you will, is based upon an assumption of 7 to 8% return, and all of a sudden you run into a 5 year period of time where the returns are more like 14, 15, 16%, like we've seen over the course of the past 5 years, well, guess what that means? That means that you got to effectively the same level of assets in half the time, right? So if you're saying projecting over the course of a 10-year period of time that returns are going to be 7 or 8%, and you run into a 5 year period of time where they're more like 14 to 16, then that means you got there in half the time. So to us, that's the perfect time to say, okay, we are way ahead on this journey. It's certainly a great time to rebalance and trim the profit, so to speak. And particularly now, obviously, if you're in your 30s or 40s, I don't know that there's any necessary need to sort of trim profit or take that profit and put it into something that is much more secure. I certainly wouldn't advocate that, because you've got a lot of years in front of you. You want to continue. Part of the ability of gaining investment return over time is the power of compounding, right? And continuing to sort of go with reinvesting and ultimately achieve that highest level of return over time. But if you're 3 to 5 years from retirement, then it really does beg the question of, okay, well, don't I want to start to sort of transition my portfolio to be away from growth and more towards the growth in income? So all of those factors sort of come into play when you think about rebalancing and how to ultimately take advantage of where things are and specifically sort of engage in that. Now, there's a couple of keys to when you start to rebalance, when you start to sort of trim profit in an account. And we want to focus on those keys, but we're going to have to take a break. When we come back from the break, we'll focus on some of the keys that you want to be thinking about if you are looking at your portfolio and you see the need to rebalance or trim some profit out of it. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So on the program, we're talking a little bit about the need to rebalance or trim profit out of portfolios, particularly in light of what's going on in the market over the course of the past 3 to 5 years. If you're looking at your portfolio return, and on a balanced portfolio that's probably 75% on the stock side, 25% on the bond side, you should be seeing returns over the trailing 5-year period of anywhere from maybe 13, 14, 15, 16%. So some pretty good numbers, and especially when you think about, well, most of the planning, or hopefully most of the planning that you did, assumes sort of a 7 or 8% return over time. And so if you're looking at those numbers, you're thinking, well, wait a minute, the past 5 years, I've basically gotten twice that, which means that in 5 years, I kind of covered the territory that I did in 10 years. So a couple of things are happening there then. If you set out as a particular target allocation of, say, 75% stocks, 25% bonds, and the stock piece has run up that well, then you're probably now like 80-20. So you're a little out of balance in terms of what you wanted for an original target allocation, combined with the fact that, like any diversified portfolio, you probably have some funds in there that have done really, really well. And in a lot of cases, most of your large growth funds these days over the course of the past 5 years have been hitting 20% or more over the course of the past 5 years. Those are obviously some big numbers that would lend themselves well to this notion of, okay, well, let's rebalance. Let's take from those that have done that well. And ultimately, if you're looking to trim the profit, you would put that into something ultra conservative, like a short-term bond or maybe even a money market inside of an account. Or maybe you just want to rebalance the mix of stocks versus bonds. That's the important and key concept that we're talking about here on the program. So we've got some of the key things to kind of be thinking about when you do that. We're going to talk about that next. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here live on the News Radio WFLA Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 15,000 downloads of our program. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind. So what are some of those factors to kind of be thinking about? If you're looking at your portfolio and saying, okay, I get it, Joel, I see where, kind of the allocation isn't the same as what it was because of what's going on in the stock market, or hey, maybe I've got some of these large growth funds that have really done incredibly well over the course of the past few years. And so here's some of the key things to be thinking about before you just start moving stuff around inside your investment portfolio. Number one, be careful if you're doing it in an after-tax account. Rebalancing works really well in a retirement account because anytime you move money around in there, there's no tax implications. It's all inside the retirement account wrapper. But if you're doing it on an after-tax account, make sure you're very careful at looking at, okay, well, what are the tax implications going to be if I decide to move money around in that account? Number two, and we talked a little bit about it earlier, you don't necessarily want to do sort of a trimming of the profit, if you will, if you're on the young side, right? I mean, the power of investing and the power of compounding is this notion of reinvesting things and letting it continue to compound over time. So you don't necessarily want to be engaging in this a whole lot when you're 30 or 40. Certainly you want to be taking a look and making sure that the asset allocation is where it needs to be, but not quite actively engaging in this notion of trimming the profit. Number three, obviously look inside the IRA. That's the best place to do it. There's no tax implications on it. And number four, if you do it using the same family of funds, and this is a way that you can eliminate any cost whatsoever on this. And this is typically how we do it, is we are rebalancing inside the same family of funds. So if there's a large growth fund with fund company X, we look for a bond fund with fund company X. And then that way, when you move that money over, there's no additional cost implications or anything like that. So make sure that you're kind of being aware of those different factors that come into play when you're looking to kind of rebalance or trim the profit in some of the holdings on your position. So take a look at your accounts this week. Quarterly statements should be all in the mail. I was going through my mail yesterday, and yep, there they were, the stacks of the quarterly statements. I still get mine by mail, by the way. Hey, if you want to get yours electronically, that's fine. I still like to have the paper to touch it. And sometimes people, when they do the email thing, they like change their email, or they sort of forget, or they never open it, or it winds up going to junk, and then you don't really know what's going on in the account. So anyway, I'm still a fan of mail, by the way. When it comes to receiving my investment statements, look at the specific returns. Once you get those quarterly statements, kind of look at the overall return for the portfolio as a whole. That's number one. But then specifically dig into, okay, what are the specific returns on the funds that I own? And then that should help guide you as to sort of where the rebalance or the trimming of the profit needs to happen. So that's kind of the story of the markets and the week that was, or should I say the past few years that has been. As we look ahead to this week, we see on the calendar a looming date called April 15th. Now, the reality is that April 15th this year has a little less infamy than it typically would, because of the extra 30-day extension that the folks at the IRS granted taxpayers this year, because of all of the different changes that happen in the tax code. We've certainly talked about those at length. These changes were specifically implemented not more than, 3 weeks ago or so. And so they changed a lot of the tax rules as it relates to 2020. And so what that meant is you had millions of Americans that had already filed their return, or that were in the process of preparing their return, and now all of a sudden the tax rules have in fact changed. We're going to have an update next week on what folks who already paid their taxes, filed their taxes and paid taxes on unemployment compensation, what they need to do or what they should be looking for at this point. So stay tuned for that for next week's program, where we'll talk a little bit more about that. But the important thing about the April 15th date is that it's still an important date for a couple of different scenarios. And we want to make sure we talked about them today on the program, because of course April 15th is coming up this week. So some types of returns, number one, okay, some types of returns are in fact still due on April 15th. Trust returns are still due on April 15th. Certain corporation returns still due on April 15th. State returns still due on April 15th. So there's still those types of returns that are still due on April 15th. And then number two, and probably even with much broader implications, is the notion of quarterly tax payments. Now, if you're paying estimated taxes, then you know that you pay those each and every quarter roughly. Typically in April, June, September, and January would be those dates where you're sending in those quarterly estimated tax payments. We'll know that while the tax filing deadline got extended to May 17th, the deadline for your first quarter estimated payment for the year 2021 did not. So that still stays at April 15th. So those are some of the things that you need to be aware of when it comes to your taxes and exactly how that's going to work for this year. Yes, you get the extension, but understand that April 15th still exists for certain types of returns, and more specifically, the quarterly tax payment. We're going to take a break. When we come back from the break, we are going to be talking about some of the sad financial stats that came out in the latest financial study. It's Fidelity Investments 2021 State of Retirement Planning Study. We're going to share some of the results on that, along with some of the misconceptions that study uncovered that we want to correct here on the program in the next segment. So stay tuned for that here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Latest industry study surveying folks in terms of how they feel about retirement and asking them just some simple questions about some of the things that they may run into later on in their lives when they are retired yielded some mixed results. So we're going to talk about the survey. It's Fidelity Investments 2021 State of Retirement Planning Study. Next up here on the program, Dollars and Cents. Welcome back to the program where we help you try and make some sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So on the positive side, the 2021 State of Retirement Planning Study showed that more than 8 in 10 Americans indicate that the events of the past year haven't necessarily impacted their retirement plans. That's really great to hear. That means that a lot of people didn't, ultimately reshuffle their portfolio a year or so ago, sort of at the peak panic time of the pandemic. Hopefully that means then that they've all kind of enjoyed this increase in the markets and seen the corresponding increase in the numbers in their retirement. So that's good. It's more than 8 in 10 say it hasn't really impacted. That is the good news. With another 1/3 of boomers, simply saying, it'll just take 2 or 3 years to get kind of back on track. So 82% still very confident about their retirement goals. So that's the good news. So we got confident people that don't feel like they have gotten sidetracked as a result of the pandemic. But consider some of the other findings that suggest that their confidence might very well be misplaced. And there's 4 findings that we want to share with you on the study today. So bear with us because we're going to read them. Number 1, when asked how much someone should save for retirement, only 25%, that's 1 in 4, of respondents accurately indicated that financial professionals recommend having 10 to 12 times, that's a good general rule of thumb, your last full year of working income by the time you reach retirement. So only 1 in 4 got it right in terms of how much money they actually need in order to engage in retirement. Here's the even more disturbing part of that same question. Half of all respondents, 50%, thought 1 in 2, thought that the figure would only be 5 times or less. Folks, that's not going to work. If you think you need just 5x your income, your annual income to go into retirement, you're going to have a problem. So that's a big misconception that needs to be corrected and underscores maybe the confidence that Americans have in their retirement plan might very well be overstated, especially if you got half the folks thinking they only need 5x their annual salary, and the reality is you need probably more like 10 to 12. Again, that's a general rule of thumb. It depends, of course, on lifestyle, what you want to do in retirement and things like that. But let me assure you, in order to have a better retirement, you would shoot for more than the 10 or 12 times your annual salary, and 5 times is not going to cut it. So that's a disturbing understanding or misunderstanding that Americans have out there as it relates to retirement. Number 2, nearly 1 in 3, 28%, I guess you could actually argue that that's more like 1 in 4, but so be it. It makes it sound better when you say 1 in 3, right? 28% said that financial professionals would recommend a withdrawal rate of 10 to 15% of retirement savings per year. Folks, if you're thinking that you're going to be able to withdraw 10 to 15% per year and have that account actually last for the entirety of your retirement, you've got a problem. Most financial professionals generally encourage a withdrawal rate of between 4 and 6%. We're actually going to be kind of talking a little bit about that in our next segment when we go talk about some of the factors to determine your ideal retirement withdrawal rate to be used in retirement. But I can assure you, it ain't 10 or 15%. That's a bad misconception that folks have, especially when most folks in the financial industry typically recommend between 4 and 6. 10 and 15 is not 10 to 15%. Wow, that's, yeah, you're going to run out of money there. I know how that one's going to play out. Number 3, most respondents underestimated the cost of out-of-pocket health care for a couple in retirement, with 37% guessing between $50,000 and $100,000. In fact, here's the real number. For a couple retiring at age 65, the actual cost throughout retirement for healthcare is in fact 3 times larger, estimated to be $295,000 according to research. So watch out for making sure that you are properly budgeting exactly what the expenses are going to be in retirement. If you're thinking healthcare is only going to cost you 50 to 100 grand, yeah, you got another thing coming. It's probably going to cost you 3x on that. And then lastly, on some of these findings that we found particularly disturbing, given how confident people were and the fact that confidence may very well be misplaced. Number 4, as for the impact of divorce on Social Security, 63% of respondents think a former spouse has the ability to reduce their monthly benefits. That's not true. One's Social Security benefits is never reduced if an ex-spouse claims their Social Security on your record. So an important distinction to note as it relates to the Social Security and how claiming strategy certainly affects. So some pretty disturbing conclusions on that. The study also found much greater concern for women over men, particularly some disturbing trends among divorce rates that are among older couples, and also, of course, longevity. The reality is that women live longer than men, so we'll share with you those statistics as well. So for couples, women aged 55 to 64, the divorce rate has tripled since 1990. For women aged 65 and older, the divorce rate has increased 6-fold, 6x. Factor in the fact that women live longer than men, and that's a pretty bleak picture. The study determined that that as of now, women comprise 74% of solo households over age 80 and above. So some even more disturbing statistics when you look at it more from the female perspective. Here's the reality. A couple of things, a couple of tips that we would share with females specifically out there, particularly as it relates to these disturbing trends and statistics. Number 1, get involved with the finances. I think that's a mistake that folks often make, is they don't really get involved with the finances and they sort of leave it to the partner. It just amazes me how every week somebody comes in and says, well, now I have to deal with this because my husband used to deal with it. And the reality is that you will be more comfortable in dealing with it and have a better understanding of it if you're sort of learning it and doing it along the way, paying bills, knowing what's out there, knowing what debt, what the cash flow looks like, money coming in, all those kinds of things. The more that you can inform yourself about that, the better shape you will be in. And then number 2, make sure that along the way you are also planning for your finances as well, that if you're saving for a retirement account as well. In today's world, even though you may not be working outside the home, you can still do something called a spousal IRA that allows you to contribute money to a retirement account regardless of whether you have your own W-2 or work outside the home. So understand that there are definitely some options that you've got to be able to fund your retirement as well. Don't just rely on all the retirement dollars going into the husband's account. The reality is that these issues are particularly unique to women, especially with that six-fold increase in divorce if you're over age 65 and older, six-fold increase since 1990 for folks over 65 that have experienced divorce. So some alarming trends on that. The important thing is make sure you know and you have a handle on your finances. Don't be blind to that. And then make sure you're also funding your own retirement along the way. Speaking of funding your retirement, once you have funded your retirement, what are some of the factors to use for determining the right retirement rate, withdrawal rate? We're going to talk about that coming up next here on the program, Dollars and Cents, after these messages. So what are some factors that you need to use when finding your ideal retirement withdrawal rate? How much can you comfortably take out of your accounts each year is unique to you and your circumstances, and really these factors that we're going to talk about here in this next segment. So welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So what are those four main factors to consider when thinking about what your retirement withdrawal rate needs to be when it comes to retirement? Well, first and foremost, of course, you've got to kind of look at the expenses, right? What is it exactly? How much will you actually need in retirement? And when you think about expenses in retirement, you want to be thinking about those fixed expenses, those expenses that come in each and every month, like your real estate taxes or your homeowner's insurance or any of those kinds of things. Hopefully it's not a big giant mortgage, because you probably wanted to have dealt with that prior to retirement. But those are the fixed expenses. And then compare that versus the variable, right? The variable expenses would be sort of the travel expenses and the fun expenses, the hobby expenses, things like that. And then determine how much of those and what that total number is. The lower the expenses, right? The lower the amount that you need, then obviously you can have a lower withdrawal rate on your retirement savings, on your investment savings that you've put aside for retirement. And that sort of makes sense. And then the lower the withdrawal rate, the more the likelihood is that those assets are in fact going to last and also even get some additional growth on them over time. Too many expenses, right? And you risk running out of money by taking a much higher withdrawal rate. Think back to what we were talking about in terms of the latest study about financial misconceptions, and folks thinking that they could withdraw 10 to 15% out of their savings every year is just ludicrous. You really need to be focusing on reducing down your expenses if you are finding that you are in that kind of a demand of income to cover expenses. One of the biggest things that you can do along the way as you approach retirement is not just save money for retirement in your employer-sponsored plan and the like, but in essence focus on paying down debt and reducing your debt, whether that means your mortgage or your car debt or any of those kinds of things. You want to certainly focus on that pre-retirement to help eliminate or reduce down the expenses as much as possible, because that's one of the big factors that determines how much your withdrawal rate or your withdrawal rate is going to be when it comes to retirement. Number two, of course, what also comes into it is the rate of return, right? What in fact will you earn during the course of retirement on the money that you have saved? And this gets into asset allocation, how much in stocks, how much in bonds, and then more importantly, balancing the risk that you're taking with the return that you are trying to achieve. If you run too conservatively, right, then you're going to have a lower return, which in essence is going to force you to use a lower withdrawal rate on your accounts, because if your accounts are only making 1%, then you really can't take out 5% on that, because ultimately you're going to run out of money, considering that you need to be planning for a 30-year retirement. The reality is if you're only making 1 and you're spending 5, those last 10 years are going to be a little on the tight side, so to speak. So understand how the asset allocation ultimately drives the rate of return, which ultimately then drives how much you can successfully take out in terms of your withdrawal rate. If you're on the flip side, if your account is invested too aggressively, then you've got a higher level of volatility, and it's the market that can create damage on that rather than how much money you are taking out. So for us at Nelson Financial Planning, it's really more about balance and not using sort of a shotgun approach. So to be particularly focused on large companies that make the stuff that the world uses every day, sort of rather than checking the boxes of each different types of companies you can have, as in, I got to have small companies, I got to have emerging market, I got to have mid. Our focus would be predominantly on the large company side of things. Those have a tendency to have less volatility than a smaller company. I guess that sort of goes without saying. Microsoft, Disney, Home Depot, probably be around longer than some company that is just starting up. And then correspondingly be mindful of this fact that on the bond side, bonds don't make much money. If you're sitting 50% in bonds, we would raise the question of, okay, well, why? Even if you're in retirement, and we understand that. We understand the traditional formulas that say, oh, you've got to have 50% in bonds if you're above a certain age or if you're in retirement. But the reality is you're not actually spending 50% of your portfolio every year. At least you shouldn't, because that's not going to last too long. Typical retiree is going to spend like 5% each year. So if you've got 25% on the bond side, that's the equivalent of 5 years of income, right? So even if the stock market sort of goes down and stays down for a period of time, with a 25% bond allocation in your portfolio, you should be able to utilize that to sort of weather through that storm until such time as the markets recover. So don't embrace some of the formulas that are out there that would suggest that, you've got to have a much higher bond component, because the reality is that affects your overall rate of return and ultimately reduces down how much you can effectively withdraw out of your accounts. Besides the rate of return, next up, number 3, of course, is you got to consider inflation, right? The fact that you've got costs that are rising consistently across the board out there on a regular basis. What you could buy in 1989 for $500,000, now you're going to need about $1 million. Imagine that 30 years from now, right? So over the past 30 years, what you needed $500,000 for, you now need $1 million. Think of that over the next 30. What you need today $1 million for, you're going to need $2 million later on in 30 years. So understand inflation and the fact that even if you're picking the right withdrawal rate that sort of matches your rate of return, your rate of return has got to be a little bit higher to impact and cover the impact of inflation on that. And then lastly, another of these 4 key factors that go into determining the right rate of withdrawal on your savings is, of course, longevity, right? How long will you last? People are living longer, and that is a reflection on the better personal health. If you've got 10 years or 30 years, it makes a difference in terms of how long you want those assets to last. For a typical couple, age 65, there is a high likelihood, above 80%, that one of you will in fact see 95. That's a 30-year retirement. And so ultimately, those are the kinds of things that you need to plan for when you're thinking about the right withdrawal rate for your investments. With that, we'll wrap it on up and get on out of here. Thanks for listening to the program here on Dollars and Cents. This has been Dollars and Cents with Joel Garris of Nelson Financial.